Alright, and we are recording, and we're live. Hey guys, welcome to the video. We're live and going over something that is really good to know as we're still in the first scope of 2023. We really want to go over one thing that I'm currently dealing with now, and we actually filmed the video before the stream that we're going to post on Nitro. So in that video, we wrote down pretty much everything when it comes to our credit card debt. The title of today's video is how to get out of credit card debt, and this is really just my story in the past couple months of what's happened and how I'm going to get out of this. So in January, I racked up a whopping $4,333 in credit card debt. How does this happen, right? Because you can watch this video, you can watch a bunch of videos, you can watch other people talk about debt, but until you actually go get the cards and go make the mistakes, you don't really know until you actually have done it. And really what I see, why does this happen for, I guess for myself speaking, is it really just goes down to being responsible, but it's a lack of responsibility in your finances. And that is what causes debt to build up. When you have, for us, I can't speak for everyone because maybe there's other people in harder situations and they're forced to do certain things or whatever. But most of the time, you can get into debt and consumer debt, credit card debt for just very simple things. Like this phone, for example. I had an iPhone 8 Plus. Did I need to go get the 14? No, the iPhone 8 worked fine, right? It was slow, and when I was driving in the summertime, when I was taking calls and stuff or looking up maps, it was so bad that the phone would get overheated and I couldn't really use it, so I had to shove it in the AC vent of my truck for the AC to blow right here, and it would cool down the phone and then it would start working again. So, I mean, it's stupid and it was annoying that it would do that, but if I was technically speaking, do I really need to get a new phone? No, I could have still used it, and that would have saved me $1,000 because this costs $1,000, really expensive, and we're still paying that thing off because we put that on one card. So it's stuff like that that can build up, this debt pile. Now, $4,000 in credit card debt. From watching the other Dave Ramsey videos, it's really not horrible. It could have been worse. There's some people that have 20, 30, 50, maybe even $100,000 in debt, right? And it just can get worse if you don't target the little things that are holding you in debt, right? So a lot of times, the problem with using credit card is you don't really think about the spending you're doing. You just go tap the card, tap the card, tap the card, and you just keep racking. Now, if you use cash, it's different. You see the money in your hand. You see the $20. You see when you hand it over that it goes from a 20 to 10s to 5s to 1s to change. And you're like, oh, this is sad. I had a $20 bill and now it's all jumbled up. Now it's a 5 and a 10. You see your money go down. So it really hits you in your mind. It's different. Now, I'm not telling you guys to go back to cash and cut all the credit cards. I'm not that cold turkey. I think credit cards are great. You just need to handle them responsibly and know, it's a double-edged sword. It can either help you or it can hurt you. So yeah, that's where we're at, and in this video we're talking about how to get out of credit card debt. So we watched a great video on it. We may go pull it up on this one, but this is Investopedia. If you don't know about Investopedia, it's a great website for learning how to invest in stocks. I think it has some crypto stuff. It even has a simulator if you want to mess around with that. So for today's video, we're looking at credit card debt. What is credit card debt? It is a type of unsecured liability that is incurred through revolving credit card loans. Borrowers can accumulate credit card debt by opening numerous credit card accounts with varying terms and credit limits, all in credit limits. So let's stop there. Now, where are we? Let's pick one. Okay, so, Citi. Our Citi card as of January was $1,187. On February 5th, 23, our current balance is $327.89. So that's today. That's how much you owe right now. Our APR on that card is 19.49%. And so that could probably fall under what it says varying terms. Different cards have different amounts. The Chase card has 29% APR for the cash advance. The Citi has 19% for your APR. Okay, the Capital One has 31%, and it has a $40 late fee if you're late. So the problem is, if you have a bunch of cards and you got money on all of them spread out, and you're not paying the minimum payments, and you're getting all these late fees and stuff, it starts to add up quick, right? You don't really think about it, but when you get hit with a $40 late fee, and let's see, $40 times 2, that's 80, times 4, that's 160. You got 4 cards, they're all late. That's $160 just in late fees. So you can see how that stuff starts to compound. Let's go to the next part. All of a borrower's credit card accounts will be reported and tracked by credit bureaus. The majority of outstanding debt on a borrower's credit report is typically credit card debt, since these accounts are revolving and remain open indefinitely. So let's go to the key takeaways. While useful for making purchases over time, credit card debt does carry some of the industry's highest interest rates. Credit card debt typically accounts for a significant portion of credit utilization on a borrower's credit profile. Paying down substantial portions of outstanding credit card debt is one of the best ways to rapidly improve your credit score. So our score right now is 523. That's what it says on the Chase app, and it says we've gone up about 18 points since paying down these cards. Here's a problem that I made and that I want to share with you guys so you guys don't make, is if you have a card, and for one, I had the TD Bank, the Target card. Okay, somehow I bought the fish and some veggies and I racked it up to $14. The card limit is $500. I spent $14. That's fine. Here's what happened. I forgot about that and went months and months and months, and then it would show. I get these, in the mail. I get a letter, but I usually would ignore them. I wouldn't read them. I'd just be like, yeah, whatever. And that's stupid, right? Because that's carrying a balance on that card, and that started to start kind of cutting my score, because each month they said, hey, RC is not paying his credit card. He spent $14, and at the end of the month, RC is supposed to pay off the $14. He doesn't pay it off. And I did that a couple months, so that started really killing my score. Now, not only that, I did the same thing with the Lowe's card, the same thing. There's like $5 or $10 on it, and then each month go by, not pay it, bam, cut more points off. And that's what really destroyed the score. Not to mention that in the Chase card, holding over a $2,000 balance on it and not really paying much on it, we did pay, $40, $50, so that was decent. It was getting the minimum payments, but it still was holding such a huge balance, and most of the credit usage was spent, right? And I was holding that balance months and months and months. That started killing the score. So avoid holding any balance past a month. If you're gonna use the card, pay it off a couple days or whatever before the end of the month. You can set up auto payments. In the video we saw earlier, she was saying that the least you can do is pay the minimum payments. Definitely do that to keep your score from getting hit any worse than where it's at right now. So that's kind of where we're at on all of that. And let's see what else they're saying on here. And we might pull up that video. So here's an interesting one. It says benefits of credit card debt. Credit cards are one of the most popular forms of revolving credit and offer numerous benefits for borrowers. CCs are issued with revolving credit limits that borrowers can utilize as needed. Payments are typically much lower than a standard non-revolving loan. Users have the option to pay off balances to avoid high interest costs. Additionally, most credit cards come with reward incentives such as cashback or points that can be used towards future purchases or even to pay down outstanding balances. And you know what? That is true. It is nice. Like the Citi card, Costco, since we've used that for about a year, in February when the statement closes, they will issue a certificate of their cashback, and it says on the app that we have an eligibility of $155. And that's real money that they're going to send back to the consumer, and that's really cool because you can use that money to put it in your savings account and build up your emergency savings, or you can put it in an investment account, right? So it is nice that you have those points. Also, the Chase card, what's cool about that one is they give travel points, and they're pretty reasonable on their stuff. I think they give about 3% on certain things. Not everything's 3%, right? You got like 3% on travel, and I think you could switch that 3% thing around to where you spend most of your money, right? If you're spending a bunch of money on your credit card and you're like, well, I don't care about going to Chili's or going to Louis Vuitton. I want all this money and points to go towards travel because I like to go travel around and go see the world. Well, you can do that. So yeah, that's pretty much all of that. I know we're talking quick and going kind of fast, which we don't want to keep you on forever. So let's go to, I don't know if we read Understanding Credit Card Debt. We haven't read this one. Generally, credit card debt refers to the accumulated outstanding balances that many borrowers carry over from month to month. CC debt can be useful for borrowers seeking to make purchases with deferred payments over time. This type of debt does carry some of the industry's highest interest rate. However, credit card borrowers do have the option to pay off their balances each month to save on interest over the long term. Credit Bureau Reporting Analysis, what to know. Lenders report credit card debt level balances to credit bureaus each month, along with the borrower's relevant credit activity. Thus, credit cards can be an excellent way for borrowers to build out a favorable credit profile over time. However, negative activities such as delinquent payments, high balances, and a high number of hard inquiries in a short period of time can also lead to problems for credit card borrowers. Okay, CC debt is highly influential in determining a borrower's credit score, since it will typically account for a significant portion of credit utilization on a borrower's credit profile. Credit bureaus track each individual credit account by itemized trade lines on a credit report. The aggregation of outstanding credit card debt from these trade lines is the borrower's total credit card debt, which is used by credit bureaus to calculate their credit utilization ratio by dividing it by the aggregate amount of credit limits of all credit cards owned by the borrower. Man, this stuff is... They definitely did not read any of this stuff to me when I was at Bank of America the first time I got this card. They went pretty quick, and I wonder why. Credit card utilization is an essential component of borrower's credit score. Important. Credit card debt is a major factor in determining a borrower's credit score. Okay. And you may think, like, what's the point of reading this stuff? This is boring. I just want to pay off my credit card debt. Whoop-de-doo, I don't care. Well, if you're like me and you're in real estate, I'm a property manager and that's what I do. It's important to know why this stuff matters. And it matters because if you want a lender to lend you money so you can go buy real estate or you can go buy certain things that you need, well, they're going to be looking at your credit score. And they're also going to look at other things too, but I know they're definitely going to look at your credit score. If they see me with a 523, that kind of sucks. Who's going to give a loan to an individual who has a 523 credit score? That shows, hey, this guy is not responsible, he doesn't pay his cards off, he's holding a balance, whoop-de-doo, right? If your credit score is good and you're bringing in money that's cash flowing every month and they can see, hey, it's going to this bank account, this is where he moves his money, it's very simple, he's built up a savings account, say you got 10, 15,000 in savings, that's going to look really good for the lender to lend you money to go buy a house or whatever you're trying to do. So I think we're right here. Okay, so lenders will report a borrower's payment activity to credit bureaus each month. Delinquent payments detract from a borrower's credit score, while on-time payments help their credit score. Maintaining on-time payments helps a borrower to achieve a higher credit score, qualify for better lending terms. Okay, so maintaining on-time payments, you get a higher credit score and qualify for better lending terms. Since credit utilization is also a factor in a borrower's credit score, paying down substantial portions of outstanding credit card debt is one of the best ways a borrower can rapidly improve their credit score. Keeping credit card balances low will also help a borrower to maintain a good credit score. So that's the thing, is you can, once you get the score up, once you pay it down, it can rapidly improve their score.
but then keeping the credit card balance low will keep your will help maintain a good credit score. So that's the next thing is, well, once you get to a good score, what's your good score? Maybe 750, 800, which is really hard to get to, by the way, but say 750. Well, how do you stay at 750? How do you keep it from going back down, right? Because everything you do will affect that score. Either will help it go up or it's going to make it go down. And we've seen, based on this video and what will be posted later, that don't do what I did, because that's what makes your score go down. Let's check this out. A savings account with competitive interest rate, maximum savings with minimal hassle. Okay, so they're trying to show you some stuff. That's cool. Also, another thing about Investopedia that you may like is, if you don't want to read all this stuff, well, then that's okay. It's fine. I'll make more videos and I'll read it for you, so you can just listen and do other stuff. But if you want to just get straight to the stuff, go all the way down to related terms, and a lot of times they'll have the definition just posted on the bottom. Now, it does say related terms, so it's not saying all the terms in this video, in this article, will be down here. But most of the stuff that they're talking about, like what is a revolving account, bam, a revolving account is a type of credit account which provides a borrower with a maximum credit limit and allows for varying credit availability. So if you really want to take it to the next step, you may write down all of these and just write it out. How we used to do this on our folder is in pen we'd write the title, and in pencil we write the paragraph. One, it's easier to see. If you write it all in the same ink, you're just kind of like, what? And that really kind of helps stick with your head. There's something about writing stuff down with a pencil or a pen that just links from your hand all the way to your brain. The problem with these phones, and even with the credit cards, is you are always using it. You're just scanning it, tapping it, scanning it, tapping it, and you're not really feeling the pain of spending, right? You just kind of like, oh, that's $4, click. Oh, it's $4, click. Oh, it's $4, click. And now that's $12. Right, and then there's another $12. Now you're at $24, and then another $12, and whatever. I gotta work on my math, right? And that's what we've been doing. And so Salt Bros in the morning, that's $4. Then Chick-fil-A, say that's $10. Okay, that's $14. Then we need to go to Whole Foods and buy water. So we're at $14 now. We spend another $4, and we're at $18. Okay, so that's $18. So now, just to break even for the day, you need to make more than $18. Hopefully you're making more than $18. But as you can see, you start to realize if you're racking up a daily expense rate of $50, right? And that's just how much you're spending daily to do what you're supposed to do, which is very high. We can run the math on that. So $50, which I'm sure a lot of people are doing this, $50 times, let's say you're spending that every day, right? 31. That's $15.50, right? Is a lot of people doing that? Probably not. If you're spending $50 every single day, that's a lot. But yeah, there you go. So now multiply that by 12, and just your daily habit is $18,600. Now you can start to see how bad this can get. So for me, spending $4 on Salter Bros every freaking day, it's a great coffee shop and it's nice, but you're doing that, say 30 days out of the month. That's 120 times 12. I'm spending $14.40. And now you see, that's crazy. That's just coffee, right? So then you do, say, the car wash expense. To have the monthly subscription for the truck, that's $40 a month. Times 12, that's $480. So that's another thing we'll do in the next video, is we'll write down every monthly expense we have, multiply it by 12, so we can get a scope of view of how much are we really going to be spending. You don't have to wait till the end of the year to find out how much money you have left over, right? If you have subscriptions, say you got Hulu, and that's $2. So you got the Costco card, and I think that's 60 a year or something. Okay, let's not count them ones. So there's Hulu, say that's $20. Netflix, $20. The car wash, another $40. You just start adding those suckers up, and you start to see, okay, that's just how much I'm spending in a month. Multiply it by 12, and you'll see what those figures will be like in a year from now, right? Just multiply it by 12. So I know it's a lot. We talked really fast, and a lot of people are probably confused. So if you need to slow down this video, great, or you can speed it up. And so yeah, that's pretty much that.
So our current balance right now, as of February, is 2,959.89. That is our current credit card debt as of February 5th, 23. And that was written at 104. It's 133 now. Since January, we've paid 1,373.11. So 1,373.11. And that's pretty good. So next, we got to just get the 2,000. Basically, we got to get the 3K paid off. And after that, we're going to be setting a lot more discipline on our spending. And you could say that, but how we're actually going to do that is we're going to write down on the next piece of paper, and I'm going to do this off camera, but I'm going to write down all the expenses I currently have right now, all these subscriptions, and see what are those numbers going to be times 12, and then let's add it up and see where that would be. Because you do that now, it's only February 5th, right? It's not the end of the year. So now you can see how much money you're really going to spend if you stay on that trajectory, and you can change how much you're going to have at the end of the year based on doing that. So if you guys like this live stream, please hit the subscribe button, like button, comment down below what are your strategies for getting out of credit card debt or managing your finances, and we'll definitely look at it. So thank you guys so much for watching this video. I hope this helps, and if you have any questions or concerns, feel free to leave it down below. So I'll see you guys on the next one. Thanks.